Have you ever started your own business, formed an LLC, and then realized you had no idea how to actually pay yourself? You've put in the blood, sweat, and tears to build something incredible, and now it's time to reap the rewards. But how do you do it legally, efficiently, and without causing a tax nightmare? It's a question that stumps countless new business owners, and for good reason. The way you pay yourself from an LLC isn't as straightforward as just writing a check. It depends on several crucial factors, primarily how your LLC is taxed by the IRS. Get it wrong, and you could face penalties, tax complications, or even jeopardize the very liability protection your LLC offers. This isn't just about getting money into your personal bank account. It's about understanding the nuances of business finances, maintaining a clear separation between your personal and business funds, and optimizing your tax situation. Because while the limited liability company structure provides excellent protection for your personal assets, it also comes with specific rules for how its owners extract profits. Think of it this way: your LLC is a separate legal entity, even if you're the sole owner. Just as you wouldn't walk into a big corporation and simply grab cash from the till, you can't do that with your LLC's bank account without proper accounting and tax considerations. This distinction is vital for maintaining the limited liability aspect of your LLC. Commingling funds, mixing personal and business money, is a quick way to lose that protection, exposing your personal assets to business debts and lawsuits. So let's dive into the core of it. We'll explore the different ways you can pay yourself from an LLC, focusing on the most common scenarios and how LegalZoom can help you navigate these important decisions. Understanding your LLC's tax classification. The foundation. The first and most critical step in figuring out how to pay yourself is understanding how your LLC is classified for tax purposes by the IRS. This is often where the confusion begins because while an LLC is a legal entity, it's not a tax entity in the same way a corporation is. Instead, an LLC is typically a pass-through entity by default, meaning its profits and losses pass through to the owner's personal tax returns. Here are the most common tax classifications for an LLC and how they impact how you pay yourself. Single-member LLC, defaulted as a sole proprietorship if you're the only owner of your LLC and you haven't elected a different tax classification with the IRS. Your LLC is automatically treated as a disregarded entity and taxed as a sole proprietorship. This means your business income and expenses are reported on Schedule C, Form 1040, of your personal tax return. How you pay yourself. As a sole proprietor, you typically pay yourself through an owner's draw. This is essentially withdrawing money from your business bank account and transferring it to your personal bank account. There's no formal salary or payroll involved in the traditional sense, and taxes are not withheld from these draws. Instead, you'll be responsible for paying self-employment taxes, Social Security and Medicare, and income taxes on your LLC's net profits, regardless of how much you actually take as a draw. It's crucial to make estimated tax payments throughout the year to avoid a big tax bill or penalties come tax time. Multi-member LLC, defaulted as a partnership if your LLC has 2 or more owners and hasn't elected a different tax classification. It's automatically taxed as a partnership. This means the LLC files an informational return, Form 1065, with the IRS, and each member receives a Schedule K1, reporting their share of the LLC's profits and losses. How you pay yourself. Similar to a single-member LLC, multi-member LLC owners generally take owner's draws. These draws are typically based on the agreed-upon profit-sharing arrangement outlined in your LLC's operating agreement. Again, no formal salary or payroll withholding, and each partner is responsible for their own self-employment and income taxes on their share of the profits. Guaranteed payments. In a multi-member LLC, partners who provide services to the LLC, e.g., managing the business, can also receive guaranteed payments. These are payments made to a partner for services rendered, regardless of the LLC's profitability. Guaranteed payments are deductible business expenses for the LLC and are subject to self-employment tax for the receiving partner. LLC elected to be taxed as an S corporation. S Corp. This is a popular election for many successful LLCs because it can potentially save on self-employment taxes. When an LLC elects S Corp status by filing Form 2553 with the IRS treats the LLC as a corporation for tax purposes, while maintaining the LLC's legal liability protection. How you pay yourself. This is where it gets different. As an owner of an S-Corp, you are considered both an owner and an employee of the business. You must pay yourself a reasonable salary through payroll, with proper tax withholdings, federal income tax, Social Security, and Medicare. This salary is subject to payroll taxes. Any remaining profits in the LLC after paying your reasonable salary can be taken as distributions. These distributions are not subject to self-employment tax, only income tax. This is the key tax advantage of an S-Corp election. However, the IRS scrutinizes reasonable salary closely to ensure you're not trying to avoid self-employment taxes by taking too low a salary and too high a distribution. LegalZoom can provide resources and guidance on determining a reasonable salary based on your industry and role. LLC elected to be taxed as a C corporation. C Corp, while less common for small businesses, an LLC can also elect to be taxed as a C Corp. This means the LLC is treated as a separate taxable entity. How you pay yourself. As an owner of a C Corp, you are typically paid a salary through traditional payroll, just like any other employee. This salary is a deductible expense for the corporation. Any remaining profits in the C Corp after expenses and salaries are subject to corporate income tax. If the C Corp then distributes profits to owners as dividends, those dividends are taxed again at the shareholder level, known as double taxation. This is generally why it's less preferred for most small businesses compared to S-Corp or pass-through structures. With that said, thanks for watching, and until next time.